Well, hi everyone, Sean Humphries here. Welcome to All Things Retirement. In this installment, we're going to talk about investment planning, portfolio construction, and loanership versus ownership investments. Now, we're going to really zero in on the loanership investing area. It's a really important component to portfolio construction, and if you get this one wrong, it can really have a negative long-term effect on your retirement income planning. So you'll enjoy this installment. Now, if you're new to our channel, make sure you hit the subscribe button. We're posting content all the time on pre-retirement planning, transitioning to retirement, and being retired. And not just on the financial aspects, but the non-financial aspects of retirement. Now, when it comes to portfolio construction, it's really important that we get an understanding of the various investment options that we can utilize. We all have heard the terms, right? GIC, savings accounts, term deposits, government bonds, corporate bonds, municipal bonds, stocks, exchange-traded funds, mutual funds. The list goes on. So lots of investment options out there. I'm going to stay pretty high level today. So some of you, this might be brand new information that you'll find very helpful. Maybe for others, you've been investing for a while, but this is a good overview and summary of things that maybe you've heard before. And if you're really an astute investor, this is old hat for you, but it never hurts to kind of review some of the basics when you look at our investment planning. Now, when it comes to the two key categories of investing often, when you look at portfolios, there's going to be loanership investments and ownership investments. I'm going to focus in on what we call loanership investments. So loanership really does imply the extension or making a loan. And the most common ways of making loans for all of us would be the loans that we make to financial institutions, to banks, credit unions, and trust companies are the most common examples. So at a very basic level, when you set up a savings account or a checking account, or you buy a term deposit or GIC, guaranteed investment certificate, when you give the financial institution your hard-earned capital, you're extending a loan to them. And when you do that, you're then requiring from that institution contractually a repayment of investment income or earnings or in the form of interest, and you're asking that your capital be repaid back to you at some point based on the contract. Now, in addition to the most common experience that almost all Canadians have, you also can extend loans by buying government bonds. Typically, that is more in the institutional arena, where you have pension funds, large institutional investors, mutual fund managers, ETFs will buy government bonds, but you'll see individuals doing the same thing. So again, you're extending a loan to the government, and they're going to commit to repay you back that money at some point and pay you interest. And as well, corporations issue debt. So we often think of businesses raising capital through the sale of shares or stock, but they'll also raise capital through the issuance of bonds. And so it's a really important way for them to do that, and particularly when interest rates are really low right now, it's a common form of raising capital for those institutions. So in summary, we expect when we extend a loan to a financial institution or to a government or to a corporation, we're expecting a specific rate of return. And so when we have an investment in a bond or a GIC, we know we're going to get a specific return every year until the maturity. There's a payback of capital at maturity, so most bonds do have a specific maturity date attached to them. And this is going to be the more conservative or less risky part of your portfolio. We'll define that for you in a minute. Okay, so that's a few examples. Now, examples we already talked about a little bit. We've got T-bills, savings accounts, GICs, term deposits, individual bonds issued by governments, corporations, mortgage investments, bond mutual funds, and bond exchange-traded funds. Now, what are some of the pros and cons attached to loanership? Well, one of the advantages is loanership is considered safer, less risk. Now, when we define risk, really what we're defining here is the fluctuation of return more than anything else. But of course, more conservative investments imply a return of the capital you've extended. Less fluctuation, not worrying about losing money. All those things are pretty much the characteristics of the loanership category. But one of the disadvantages often with loanership investments, because of the guarantees that surround them, is the low return. And that is really evident when it comes to opening up savings accounts with your financial institution. So you walk into your institution and you're looking at the rate board, course, savings accounts typically have the lowest rate, and then if you're prepared to lock your money up for 5 years, that'll be the highest rate. So what you give up is liquidity or access to your capital if you buy a 5-year term deposit or 5-year GIC. Liquidity can be an important issue, so one of the frustrations that many investors have is the only way they can get a decent yield is to lock the money away, and it's difficult to access the capital. There's other issues around taxation and purchasing power, which we'll talk about. So with guaranteed investments or very conservative investments, most of the income you're going to get is in the form of interest income. And when that's outside of a tax-free savings account or an RSP or registered retirement income fund as an example, if it's in an open account or a corporate account, it's taxed at a high rate of tax. And then, of course, purchasing power is a really big negative attached to these assets. I'll talk about how they should be utilized in the context of portfolio construction, but purchasing power is something we need to be mindful of. And the longer that we lock in money, the more we can lose purchasing power if we're not getting a decent return on capital. So I'll give you an example. So I scanned the information today, just went online. And in our area, one of the best savings rates right now is about 1.3%. That's a great savings rate. If you look at 5-year GICs today, it's about 2.3%. And right now, inflation, although it's gone down because of the recent events of COVID-19, so that's going to date this video a little bit, but inflation is pretty low right now. But if you look at the last year, it averaged about 2%. And so if I got 2.3% on my GIC, it's a 5-year term every year, and let's say inflation averaged about 2%, I'm going to earn 0.3% net of inflation every year on that investment. Now, it doesn't stop there. If I have the money compounding, but it's going to be taxable down the road within my RSP account or my RIF, or I'm holding it outside of a TFSA account, and it's a taxable investment income to me, I have to pay tax. So using a relatively low, moderate marginal tax rate of 25%, on that 2.3% return, I'm going to have a tax bill every year of 0.58%. So when I factor in inflation of 2.58% for tax, I'm basically making negative 0.28% return every year. Now, that doesn't really bite you right away. That's a slow, steady kind of erosion. Obviously, if I look out the next 5, 10, 15 years, that's not a very productive way of investing for retirement. You're going to lose your purchasing power. The only way you'll be able to cope with that is reduce your spending and expenses. And we've talked before, there's all kinds of headwinds down the road, whether it's likely increased taxes because of government deficits, aging population, challenges to pension plans, and different benefits going to seniors. Taxes aren't likely going to go down, they're going to go up. And so we need to make sure we protect that purchasing power. So this is going broke safely, and you can do that for a little bit of time to reduce risk in portfolio, but it's not a sustainable long-term strategy. Now, we'll talk about how to feather fixed income in the portfolio. So even though I talk about the negatives, fixed income, loanership investments play a really important part in our portfolio. We'll talk about that in a second. Now, the other thing that we need to keep in mind is some of the investments that are in the loanership category can be traded before their maturity date. So I can lock in an investment, let's say with a 5-year or 10-year term, but I have the option to sell it. Now, that's not going to be the case with your savings account, your checking account, your term deposit, or your GIC. But it will be the case with a government bond, a municipal bond, a corporate bond. You can sell that bond before it matures. Now, at one level, a bond works just like a GIC. The example I just wrote down here is we've got a $10,000 bond and matures in the year 2025. Let's say I can get 3% of that bond. That's going to give me $300 per year. And that's usually paid semi-annually. So I'll get a couple of checks of $150 each time. Okay, pretty straightforward. Nothing really a lot different there than buying a term deposit or GIC. Now, the secondary market will put a price on the bond, and there's a few different variables that will impact the pricing. Now, the first variable that I want to take a look at is the impact of the current interest rates relative to the interest rate on your bond. So again, my example here, I've got a $10,000 bond paying 3% interest. I'm getting my $300 per year. But let's say for whatever reason, I need to sell that bond, or I want to look at selling that bond before it matures in the year 2025. Well, if interest rates have dropped down since purchasing that bond, so let's say that I'm getting 3, but now new investors getting cash can only get 2% on a bond for approximately the same term, then my bond will trade at a premium. The bond market, I'm using an example just to give you an idea. In this example, it might give you $1,000 for your bond. In other words, you've got a $1,000 capital gain that you would get by selling your bond early, because investors are going, and you're saying to the market, I'm not prepared to sell my bond earning 3% into a 2% interest rate climate. I'm expecting to get a premium because I'm getting 3, you're only getting 2, and I need to be compensated for that difference. Now, the opposite's true. If you're selling the bond into an environment where interest rates are now 4% and you're only getting 3, the bond market's going to go, well, we're not going to pay you 10. The only way we would buy your bond is we'll give you $9,000 with the maturity of 10. So we've got a built-in gain there of $1,000 for the investor. So when you compare the gain of $1,000 plus an interest rate of 3%, that's going to be the equivalent of getting 4% on new money. So the bond market's always doing this calculation, always looking at your bond relative to prevailing interest rates and looking at your maturity. So the value of your bond is going to be impacted by a whole bunch of factors. It's going to be impacted by the credit quality of your bond. So the higher the credit quality, the lower the fluctuation. So the best credit quality would be AAA rated government debt as an example. The lowest credit quality might be for different forms of corporate bonds. The length of the terms, so the longer that bond's locked in for, the more you're going to see fluctuations. So maturity date or term has an impact. Obviously, the prevailing interest rates relative to the interest rate you have on your existing bond. And then the economy. So the economic environment that you're in also has an impact on the valuations that are taking place on the bond market. So these valuations are not happening in a vacuum. It's not just based on these first 3 characteristics. So when we talk about bonds and how we utilize bonds, here are the main things you need to keep in mind. So first of all, you use bonds or you feather fixed income or loanership investments into your portfolio to reduce risk. And when we talk about risk, it means reducing the year-by-year fluctuation on your portfolio. Stocks, as an example, are more risky, fluctuates in the short term more than loanership investments or bonds. And so by adding more fixed income or loanership into your portfolio, you'll reduce that fluctuation in the short term. They're also a great way of providing for predictable income. So if I need to get specific interest payments paid to me to supplement cash flows or other sources of pension, or I want money maturing and then delivering capital to me at specific times in retirement to fund expenses, lifestyle expenses that might be coming up, bonds, loanership investments are a great way of doing that. It provides predictability. In terms of time frames, I think fixed income investments or loanership investments are great in situations where you're looking at a 1 to 3 to 4 to 5 year time frame. So if you need to deliver capital or cash flow in the next 5 years or less, then you do want to have some fixed income or loanership investments in place that have been identified to deliver that to you. So loanership can be used in 2 ways: to reduce overall fluctuation or risk in your portfolio, and secondly, to deliver specific dollars to you at specific moments of time. The downside, like I said, is you really want to be time focused on this, because if you have too much in loanership over too long a time period, you're going to pay way more tax than you need to, likely, and you're not going to get a sufficient return to maintain your purchasing power. And as I mentioned before, the long-term trends don't look good. In the Canadian landscape, as we see an aging demographic, burgeoning, ballooning deficits and debts, and increased pension plan pressures and healthcare pressures, tax rates are not likely going to go down. They're going to keep going up. So we need to get sufficient returns to cope with the negative long-term impacts of taxation and inflation. Well, it's my hope that you found this video helpful on how you can feather loanership investments into your portfolio and how to use them effectively so you have a great long-term retirement income plan working for you. Now make sure you check the notes with this video. There'll be some helpful links to get additional resources and information. As well, we've got a couple of videos that are related to this topic. Make sure you check them out. Make sure you visit our website, humphryswealthgroup.com, and like I said, make sure you hit the subscribe button.